Welcome to the Learning Lounge on Lake Sumter Television. I'm Mark Roberts, joined by Greg Parady. And for this episode, we're joined by Kathy Lassiter, CPA and CFP. Wanted to make sure I got that correct. Today, we're going to be talking about insurance. And I think a lot of people instinctively think of car insurance and homeowners insurance. What kind of insurance are we talking about?
Well, today we're talking about life insurance. Life insurance is a big part of the planning that we do for our clients. It's a big part, I think, of the equation for any type of retirement income planning. Life insurance should be part of that equation. And it's got some tremendous tax benefits as well.
Again, I think people think life insurance is to protect you in case you die prematurely. You get $100,000, $500,000, whatever the case may be. That's not the kind of life insurance you're necessarily talking about.
Well, we are talking about that, but we're also talking about additional benefits. So the primary purpose for life insurance is paying a lump sum to beneficiaries in case you pass away prematurely or you pass away just exactly when you expected. But it's for the death benefit. That has to be the primary purpose first. But over time, these contracts these insurance companies have added some additional living benefits that are really hard to ignore for a lot of people. For example, a lot of the contracts today, you can pay into them. You pay your premium. Part of what you pay goes to cover the cost of insurance, and the other part of the money that you pay in can actually start to accumulate and build what's called cash accumulation value.
Right.
And there are some tax benefits to how that grows. Additionally, you can use life insurance contracts today. They actually call them hybrid life insurance contracts where let's say you have a $500,000 death benefit that you want to go to your kids when you pass away. But you get sick before you pass away and you need to access some of the death benefit early to pay for home health care or long-term care or chronic illness. You can buy contracts today that will actually allow you to access the death benefits while you're still living and then pay the balance to the beneficiaries afterwards. So they can really be tailored to fit each person's unique needs and cover a lot of the primary risks in retirement.
And I believe what you're referring to is whole life?
Actually, we're using a combination of term and whole life. It's called universal life, which combines the low cost of insurance with a cash accumulation component that you'd find in a whole life. They've combined those two together to create what's called universal life. And then we use a specific type of universal life called indexed universal life. And we generally use contracts that will build cash value, they have guaranteed death benefits, and then they also have those living benefit riders to access early.
In a past episode when we were talking about annuities, we talked about, is there a stage in your life in which you should get in? And is there a stage in your life where it's too late to get in? There's a growth period for some of these policies?
Yeah. So life insurance, again, because it's built around the death benefit first, we're going to use it differently if you're 40 years old than we're going to use it if you're 65 years old. And I'll let Kathy talk more about how we use it in retirement for tax planning. But so if you're younger, you want to buy life insurance to have in place to protect your loved ones, to pay off the mortgage, to pay off debts. When you're retired, your debts change and your needs change. So, for example, when one spouse passes away, the short answer is there's no age limit.
Okay.
What I'm giving you now is my longer answer. A married couple in retirement, at some point, there will usually be one spouse that passes away. And when that happens, there's almost always going to be a drop in income. We're either going to lose one Social Security check and get the higher of the two, or their pension. If there was a pension, there's generally going to be some survivor benefits that are reduced, if there are any at all. And that's where life insurance can really play a big part. When you have life insurance in place, you have a pool of money that's going to be paid to a spouse or to your children or any beneficiaries. What that means is it allows you the flexibility to go ahead and use some of your other assets while you're living.
So the cash values that are building up in these policies, is there a period of time in which I can or cannot start to draw them? Are there tax penalties like there might be in an IRA if I start to draw that money out too soon?
No, that's the nice thing about the life insurance is that the rules that you have with IRAs do not apply. So you can take money out whenever you want, and depending on how the policy is designed, that income may be tax-free when you take it out. So in the example Greg gave, when one spouse passes away, if you are the beneficiary, surviving spouse, then you have inherited a tax-free death benefit. But if you are the spouse who is insured, and now you have this life insurance policy, maybe you purchased for your spouse and they passed away first, you have the cash value in that policy, and you may decide to draw on that to supplement your income, or perhaps leave that as a benefit for your beneficiaries, your children or other beneficiaries.
And if I understood you correctly, it depends on how the policy is written, but these are generally post-tax dollars that are being used to pay the premium. So is the money that's growing in the account essentially tax-free?
It can be designed that way, and yes, so they are post-tax dollars, and if the policy is designed in such a way that you're paying in over a series of years, then the withdrawals may be tax-free while you're living, and either way, the death benefit's always tax-free.
The way the money accumulates, what are the factors that determine how much that death benefit, because the death benefits, I believe, change as well over time. The more money you put into it, your death benefit grows, your cash values grow as well. What are some of the factors that determine, is that happening, and if so, by how much?
I'm going to let Greg handle that one.
So when you design the life insurance on the front end is really a critical time, right? So we have to have a general idea of how you want to fund the policy. You may want to fund this policy over a 5-year period, which means you're going to put as much money into the contract over a 5-year period as possible. Maybe you want to fund it a little bit less and you want to fund it forever. Underwriting at the very beginning of the process, so your medical underwriting will determine how much insurance. How you fund it will determine whether or not the insurance goes up or your cash value increases. So those are going to be the factors that go into that. There are rules to life insurance. Like, you can't just take all your money and stuff it into a life insurance policy and then never pay taxes again. You have to follow different IRS guidelines. They're not as rigid as some of the IRA rules that Kathy was talking about, but if the policies are designed correctly on the front end, they can do an awful lot of things and provide a lot of value. And one of the things Kathy just said, a lot of times we'll have husbands that buy insurance, they want to protect their wife. And then say the wife passes away first. We oftentimes try to get these contracts so that they're at least fully funded within 10 years. Okay, so if you're older, you might not be able to take streams of income out of this life insurance. Like, if you bought it when you're 65, we probably wouldn't use it as an income stream, but we like the idea that if you buy this insurance for a specific reason, protect your spouse, and your spouse were to pass away first, we'd like there to be as much of your premium or the much of your money that you paid into the policy available so that you can decide, you know, I bought this for my wife, she's not here anymore, you can go back in and take the premiums back out. So, you know, that's the thing everybody hates about life insurance. You have to die to win. And a lot of these contracts today are so flexible that you can really, you can offset that. You can make it work for your benefit in a lot of different ways.
I want to make sure I understand the last point that you just made. So as the policy matures, for lack of a better word, do you reach a point where it essentially starts to fund itself, where I'm not paying an annual premium?
Okay, so that's what I was talking about with the funding schedule at the beginning. Yes, so we might design it right up front. You're going to pay X dollars for 5 years, and then you won't have to make any more payments. Your death benefit will stay intact. Some people may pay for 10 years, and so on. But yeah, generally speaking, there's going to be a point in time, if it's structured that way on the front end, where you can fund these contracts, have every dollar that you put into the contract available to withdraw it if you wanted to. Of course, you'd be giving up the contract, generally speaking.
Sure.
But you can set very specific schedules for how you want to fund it, and then it's paid up. But again, you don't want to fund this contract for a purpose, and then that purpose maybe changes down the road and not have the flexibility to go back in there and take your assets back out of the life insurance contract. And so we're really mindful of that, and we try to design all of our contracts, most of our contracts, so there's that flexibility.
Is it possible to, if you will, burn through the cash value portions of it? And at that point, are you able to essentially borrow against the death benefit side?
Are you able to burn through the cash value that you've paid into the contract?
Well, it's going to provide a cash value, correct? As the contract matures, you will receive cash value. That becomes an income stream over a period of time?
That's going to be more for younger people. So that's going to be more for people in your 40s and 50s, early 50s maybe, that's really a structure and a design that I use in my own personal retirement planning. So for example, I have life insurance contracts that I fund monthly. I put way more money into them than I need to cover the death benefit. And that's because the cash is accumulating and growing at a reasonable rate. That cash, I will never be able to run, or as you put, burn through the cash value of that design, because I'm designing it for a specific purpose and I'm going to use it a certain way, okay? But if you move to retirees, so we're talking more about retirees around here, right? So if you're talking about retirees and you're 60, 65, 70, 75 years old and you're buying life insurance for your spouse, chances are you're not going to be able to design the contract to be an income source for you. Now, a lot of people will say you can, but it's very challenging to do that because the older you are, the more expensive the policies are. And it's more of a return of premium type of a benefit more than anything.
Gotcha. Hey, we call it the Learning Lounge for a reason because I'm learning as I go. We're going to step away for a quick break. We'll be back with more. We're in the Learning Lounge with Greg Parady. We'll be right back. Welcome back to the Learning Lounge on Lake Sumter Television. I'm Mark Roberts, joined by Greg Parady, president of Parady Financial, and Kathy Lassiter, who's a partner, CPA and CFP. We've been talking about life insurance, and I'll admit we call this the Learning Lounge so we can learn, and I'm still learning here. There's a distinction. Help me understand the difference between permanent life and term life insurance policies.
So term life insurance is generally going to be considered a cheaper or a smaller payment. It's going to run for a term. So you might have a 10-year term policy. You pay a little bit, it covers you for 10 years, and then the premiums either jump or the policy lapses, okay? Permanent insurance, you're going to pay a little bit more. You're going to pay it for a longer period, but the permanent death benefit is always going to be there. In other words, you're going to pay a little bit more, but you're going to get something in the end. You're generally going to build equity with every payment. It's a lot of people have over the years used the analogy that term insurance is like renting an apartment. Permanent insurance is like buying a house. You put a down payment, you're paying a little bit more, but you're building equity and you're going to own it one day. We don't generally use term insurance very often in the villages or in this area with our clients because at this stage of the game, our clients want a guaranteed return on their investment, one way or the other. So if we're doing planning, a lot of times our clients already have homes that are paid for. They already have large retirement accounts. Actually, it takes us a little while to educate our clients on where some of their risks might be. For example, a lot of our clients have accumulated large retirement accounts, tax-deferred assets, IRAs, 401ks, money that has never been taxed. And so one of the real good ways, or one of the real powerful ways to use life insurance is to use life insurance to offset some of the tax consequences of leaving tax-deferred money to your beneficiaries. Some people fall into what we call the deferred dilemma or a deferred trap. It's where your money is growing tax-deferred, but eventually it has to come out. There's no way to get that money out. And so one of the things that we do is we will design exit strategies for our clients where they start to take a little bit of money out and they use that money, they pay the tax on it, and they fund a tax-free life insurance policy so that they can pass tax-free assets on to beneficiaries. That $1 million IRA, for example, could be taxed as high as $300,000 or $400,000 directly to the IRS before the beneficiaries get anything. And so we think life insurance is a really powerful tax planning tool.
How would you describe life insurance for investment purposes? As far as is it volatile? Is it a little bit more secure? Is it a safe bet, especially in retirement stage? Number
one, life insurance is not an investment. It's insurance. So I would not describe it as any kind of an investment, but I know what you're getting at with your question. The insurance contracts that we use are going to be guaranteed. We use guaranteed benefits, and it's similar to the annuities we talked about earlier. It's earnings potential inside of these annuity, or in this case, life insurance contracts with benefits. So you pay your premiums. Your premiums should earn interest or index credits, depending how they're structured. It can never go down. None of our insurance products are exposed to market volatility or market uncertainty. None of them. We don't use any products that can go down due to market declines. Everything that we use is contractually guaranteed. So I would consider it to be a very conservative asset class that should be considered for part of your retirement plan.
Kathy, from a tax standpoint, how does life insurance fit into retirement?
Well, so life insurance, the death benefit, as we've said, is tax-free, but it allows our clients and other retirees a place to transition their tax-deferred funds into a tax-free place. Many clients, as Greg said, they have these large 401ks or IRAs. They have to take withdrawals from them when they are 70 and a half. There is no way around that. The IRS is going to make them do that. And many of our clients or many retirees want to wait. They don't want to take it out before then because they're afraid of having to pay taxes. But the truth is they're going to have to pay. Why not pay in today's dollars at today's tax rates? Take some out now, pay the tax. We know what the tax rate is. We don't know what it's going to be in 5 or 10 years. Transition those funds into the life insurance. It will grow tax-free, or it may if it's designed properly, and the death benefit will be tax-free. So it kind of provides you with a couple of different options for tax-free benefits.
And you said the death benefit is tax-free as well. Does that matter whether it goes to a spouse, whether it goes to adult children or an estate?
No, it's going to be tax-free to the beneficiaries, and it doesn't matter. That is income tax-free. There may be estate planning considerations that we would address on a case-by-case basis, but yeah, the death benefit's always going to be tax-free.
There was this psychological belief that I need to leave money to my heirs. And I get that, for instance, if you're the first spouse to die, you want to make sure that your living spouse is not left high and dry, if you will. Has that started to shift a little bit, where when we talk about the death benefit, what is the death benefit really being used for by your clients?
The death benefit for our clients is being used to pay the taxes on retirement accounts and to replace the income for their spouse. We are in a really unique generation right now, and we're really starting to see it change. We're in a generation that's really open to the idea of planning with annuities because they don't want to just kind of squirrel money away for a rainy day. They want to enjoy it. Annuities allow people to do that. If you combine the income from annuities to the benefits of having a guaranteed death benefit with life insurance, then it means it allows you to, a lot of retirees just go ahead and spend more money and do more things. Because they know when they pass away that their families will be taken care of with the life insurance. So it's to take care of their spouses first. This is not a generation that is like their parents. You know, I always say, not your parents' annuities, it's not your parents' life insurance, it's not your parents' retirement. These are folks that, you know, we call them the golf cart generation. These are folks that want to enjoy their money. They want to spend money on family trips. They want to fly the grandkids down. They want to fly up to see the grandkids. They want to fly away from the grandkids, whatever the case may be. And they're retiring without the benefits that their parents had. So again, real quickly, their parents retired with benefits. They had pensions and health insurance and dental and eye, and they generally had life insurance. This generation's not retiring with any of that, including safe havens like bank accounts that pay interest. So insurance products are doing what they've always done. It's just the generation of people that are retiring, it just happens to fit them very well, for the most part, with a portion of their money.
Kathy, you made a point a few minutes ago that I want to make sure I understand. Again, that's why we call it the Learning Lounge. I'm learning. Understanding that part of the strategy would be to start to move money out of tax deferred. Take that penalty now, because to the best of my knowledge, I've never seen taxes go down. So we are betting, if you will, that it's going to be at least equal to, if not more so. The suggestion is that by moving that money now, that whatever loss there may be or whatever penalty there may be will eventually earn back. Is that accurate?
Yeah, and I guess part of what I'm saying is that, you know, if you're in the 15% tax bracket, you may be able to take $20,000 or $30,000 more in income and stay in that tax bracket. So, you know, why wait and let that account grow where your withdrawals would then force you into a higher tax bracket? So it's not even so much of a penalty, it's just you're going to have to pay that anyways. Why not pay it now? And then from that point on, it becomes a tax-free benefit.
Can I give a short example?
Please.
Let's say you're 65 years old and you've got that $1 million in your retirement accounts. If you were 70 today, you would have to take out $38,000 a year, based on the size of your account and the IRS table for what's called a required minimum distribution. So if you're 65 and you've got $1 million, you know that when you're 70, if you still have $1 million, you'd have to take out $38,000 and pay the taxes on it, okay? So what a lot of people do is they say, well, I'm not 70 yet, so I'm going to let my IRA get bigger. And I'll take my minimum distributions out when I have to. Well, now you've got 1.5 million, for example, and now you have to take out almost 4% of 1.5. You have to take out close to 60,000 and add that to your income. So our position is case by case, of course. But if you're going to have to take out that 38,000 eventually, why not take it out now? You could probably apply it to your lifestyle a little bit sooner. And if you can't apply it to your lifestyle, then let's take it out, pay the taxes on it, and start to reposition it into a tax-favored or a tax-free position. And that's what we talk about with exit strategies. Most people don't have a clearly defined income strategy for where to take their money. And it's the people that don't need their money as much that are really the most at risk.
Final thoughts in 30 seconds. The greatest tax benefit to using life insurance as part of my retirement planning strategy.
I think just the tax-free death benefit. I mean, you can spend your assets now and leave them to your beneficiaries tax-free also, if it's designed right. I mean, have your cake and eat it too, right?
It's the closest thing to that. And I'll just add, where else can you put $1 into a life insurance contract and have it immediately be worth $3 as a death benefit? I mean, that's the kind of leverage you're talking about. And then you add that they're tax-free, it just makes it very difficult to ignore those benefits.
Kathy, Greg, thank you both so much. I do feel learned, and that's why we call it the Learning Lounge. We're going to take a quick break, but when we come back, we're going to go to our Parady Cares segment. We're going to talk about the power of giving. You're watching the Learning Lounge on Lake Sumter TV. We'll be right back. Welcome back to the Learning Lounge with Greg Parady on Lake Sumter TV. I'm Mark Roberts. We've gotten in the habit of spending the last few minutes of each episode talking about one of the Parady Cares elements of your company. Now, I'll admit I first heard about you just about a year ago. Walmart Angel walked in and started swiping your credit card. Tell us a little bit about what was going on for you that day.
That day was that was a pretty amazing day. You know, the story's been told a lot of times, but it was a holiday party that we had that evening, and we were at Walmart buying bikes for our Toys for Tots promotion, and my wife and I were supposed to meet up at Walmart, and my partner Cindy as well, and my wife ended up texting me, I'm in the bike section, where are you? And I said, I'm in the bike section, where are you? And it turns out we'd gone to different Walmarts. Right. And so she was on the Walmart on the other side of town, and so while I was waiting for her to connect with me, I overheard somebody say that they were going to cancel their layaway. And so I just kind of wandered into the layaway section and grabbed turned out to be one of the managers there, and just said, hey, I'd like to do something. How much do you have on layaway? And she said, what do you mean? I said, how much is the total balance? And she told me it was like $89,000 or $90,000. And I said, well, you know, I'm not willing to do that, but let's try to find a unique way where we can knock that bill out and affect as many families as possible. Let's try to get as close to $20,000 as possible, and they were terrific. And what we ended up doing was paying off half of every layaway balance that was over $200, and it was tremendous. Then I went on vacation, and when I went on vacation, then it kind of got out what happened.
Yeah, it blew up. A lot of media exposure.
A little bit of media.
But you know what, though? From what I understand, though, that was just a highly publicized instance, but it truly is an encompassing philosophy of both you and your wife and your company as a whole.
It's really the foundation for how we do everything. So, you know, we've always believed that the more you give, the more you get, and the more you can shine a light on people that need help, then the bigger impact you can have. And so what that did was it just shined a light on us, introduced me to other parts of the community I never would have known about. So I got very involved with elementary schools after that and started to meet some really wonderful children, but also the teachers that work with them. And ultimately, that's where the Parady Cares Foundation was born, and that's a nonprofit foundation that we own or that we operate that is to benefit the children of our community and also other worthwhile causes that are right here in the communities that we live in.
Talk to me about the general philosophy of the power of giving. It would be really easy for people to say, well, that Greg Parady guy, I mean, he's obviously making a pretty good living. He's got this money to just give away. Maybe I don't have as much, but I can still have an impact at a scalable level.
Yeah, so we actually tried to test that. So, you know, a lot of people think the power of giving is all about money, and it's not about money. It's about giving your time. It's about giving of yourself. It's about thinking of others before you. And so we actually did a test where we provided the fourth graders at the Villages Elementary School of Lady Lake $25 gift cards, the fourth graders, children that could probably really use $25, right? And we asked them to spend that $25 on somebody else. The idea being that we also, one of the stipulations, of course, the teachers worked with the parents, but the stipulation was spend it on somebody else, preferably a stranger, and then tell us about it. And the response was phenomenal. I mean, you just can't even imagine the difference that I think it made in their lives, and also the difference that they made in other people's lives. And it was just a phenomenal thing to be able to work with young people and teach them about the power of giving. And it's been terrific.
You're using a book now to kind of perpetuate that a little bit. What would Santa do?
The book is titled What Would Santa Do? Yeah, and the book just kind of chronicles the story with Walmart, how things started with me, but then how we tried to pass that on to others. And what would Santa do? It's not about me as Santa or any Santa. It's that we all have an opportunity to give and to act as Santa at random times during the year. And the book is in production right now, and it is titled What Would Santa Do? We hope to have it this year for the holidays, and we think it'd just be a really good way to really, things have gotten so busy and so hectic anymore that people start to forget what the true meaning of Christmas is all about and the holidays are all about, and it's really just to shine a light on the power of giving, and we're really excited about it.
Thanks so much. We look forward to seeing that. You've been watching The Learning Lounge on Lake Sumter TV with Greg Parady. I'm Mark Roberts. Thanks so much for watching. We'll see you next time.